and welcome to Sobel Insights. Sobel Insights is a weekly series. We provide some brief information on various topics. At this time, we don't offer CPE. If you have any ideas for topics, please feel free to reach out to me. Today's topic is New Jersey bait. Somebody mentioned it. I took the bait hook, line, and sinker. And our presenter today, for the first time ever, he's been sponsoring this thing the whole time, is our managing partner, pretty much the author of the New Jersey bait, Alan Sobel. Alan,
hey,
welcome, and I can't believe you're finally on this.
It seems like I've done it before, but I guess not.
No, I've been blocking it the whole time. Clients been dying to hear from you, though. And this is one of the things that they want to hear about. And not just our clients, our partners, everybody want to hear about this. Let's start off with an easy one. What is bait and how does it differ from PTE?
So first of all, Brad, bait is basically a version of a PTE tax. Now, those are all initials, so let me take you back. Prior to the Tax Cut and Jobs Act of 2017, individuals could deduct state and local income taxes on their individual income tax return. And many businesses are formed as what are called pass-through entities, PTEs, pass-through entities, which means as a partnership or as a subchapter S corporation, they pick up that income on their individual tax return and pay taxes at that entity level. When the tax deduction went away under the Tax Cut and Jobs Act of 2017, essentially the ability to deduct income taxes or state income taxes on a business no longer was available. And so what the BAIT did, the Business Alternative Income Tax did, what it did was essentially converted the taxes that you would pay on a flow-through entity or a pass-through entity, partnership, S corporation, into an entity level tax, which then would be a deduction in computing federal taxable income.
And added back for state taxes, so the state was even.
The state was even, right? The beauty of this program is that it's revenue neutral to both the state, in this case, New Jersey. It's revenue neutral to the state, but it is a huge tax benefit towards business owners in reducing their federal taxable income because of the recharacterization of the expenses, the deductible expense on the entity return.
So I will say, just as a little anecdote, I was there the day standing by somebody's desk when you conceived this idea. This germ started growing and growing and growing, and watching and see how you took it through all the way through with the New Jersey Society of CPAs, through the legislature, and thankfully New Jersey passed it. We put you on our shoulders and carried you around the office. And then unfortunately, we had to put it into effect. And it was a little bit of trouble last year. New Jersey wasn't fully ready for it. We weren't fully ready for it. It was successful ultimately, thanks to everybody's efforts, but it was a little bit of trouble. Fortunately, January 18th, they signed a new law and there's some changes now.
That's correct.
What are those changes and I know some of it doesn't take effect for last year. It's prospectively, not retroactively, but what are the changes?
So let me just take one step back, Brad, and just talk about the implementation in the initial year, because that's what the changes are really intended to do, is to correct some of the things that weren't as clear as they could have been in the initial legislation. So when the BAIT went into effect for 2020, which meant most of the work was being done in 2021, the New Jersey Division of Taxation interpreted aspects of the legislation that were not as favorable to the taxpayer, to the business owners, as we believe the initial legislation was intended to be, the legislative intent was intended to be. And so there were things like the way that you computed taxable income for purposes of the BAIT was different than what it would be for purposes of computing it for New Jersey individual or business tax returns. Most notably, New Jersey was starting with federal taxable income as opposed to New Jersey taxable income, which created a mismatch, which in effect, particularly for those taxpayers that had large depreciation deductions, or in the most obvious case, the deduction of the BAIT itself, the expense itself, it reduced New Jersey income, therefore not allowing the highest benefit to take place, the highest benefit of the tax from the BAIT to take place. There were some other ones which I won't get into, but I'll talk to them more in effect as it relates to change. So we went and actually talked to the Division of Taxation and tried to get these things fixed administratively. That was our first attempt. So it's to say, listen, this was the idea here. Why can't you interpret it this way? And at the end of the day, in some cases, they were able to do that. In other cases, they said, this is the way the law is written. The council office of the Treasury said this is the way it is, and that's what we had to deal with. So that moved us to having these changes done legislatively. There were 5 major changes that we had done that were legislatively now encoded into the law. Some of them are adopted by the division even prior to the codification, but there are 5 areas of focus. The first I alluded to, which is the calculation of income. How do you determine taxable income under the BAIT program? New Jersey initially said it was based upon federal taxable income. It is clear now legislatively, and New Jersey for 2021 is going to allow for you to compute it this way as well. And that is to use distributive share of income using New Jersey's basis of income. So how you compute New Jersey income is how you will compute it for purposes of the BAIT, no longer the federal income. In many cases, in most cases, that will increase the amount of taxable income you will pay for the BAIT. Again, it's revenue neutral to you, so you're not paying any more taxes than you would have paid of otherwise, but it allows you to get a higher deduction than you would have by using the federal income.
Right.
The second area has to do with apportionment. So there was some ambiguity when they decided that they were going to change from the federal income to how they were going to compute apportionment for New Jersey purposes. And it mostly deals with the way this is for businesses, I should step back for a second. This is for businesses that have multi-state operations. And in New Jersey, if you're a partnership, you use 3 factors to determine how much of your activity is in New Jersey. You property that you own in New Jersey versus everywhere else, wages in New Jersey versus everywhere else, and sales in New Jersey versus everywhere else. And so if you have substantial operations in New Jersey, your percentage of apportionment goes higher under partnership law. Initially, New Jersey came back and said for subchapter S corporations, which adopts a single factor formula, that's what you would have to do. So if you have a New Jersey-based corporation with New Jersey owners, and they're applying it based upon sales, you could have a very nominal amount of sales in New Jersey, which would in fact reduce your apportionment. We were able to get New Jersey Division of Taxation to agree to allow the 3-factor apportionment for both partnerships and S corporations only as it relates to BAIT, and that's a good thing. That increases the amount for New Jersey business owners, how much of the income would be apportioned to New Jersey, and therefore increase the deduction. I should add that that has now been codified into the legislation, so it no longer is subject to the interpretation of the Division of Taxation. Even though they made the right determination for 2021, this now codifies that. So that's the second issue. The third issue that we encountered has to do with tiered structures. And a tiered structure is where you have a partnership that is owned by either another partnership or a subchapter of S corporation, or a combination thereof along with individuals. And what New Jersey said is that New Jersey taxation said is that when you read the legislation, it says that the credit that you get on your individual return, or that the taxpayer gets who is the beneficiary of the BAIT, can only be applied to the gross income tax, meaning that a partnership is not able to utilize that credit. And a subchapter S corporation in the partnership is not able to utilize a credit. Well, that resulted in people having to pay the tax multiple times in order to get any kind of a benefit. And in the worst case scenario, the interpretation of the Division of Taxation was that a subchapter S corporation can't even get a refund of what was paid on their behalf, and basically would sit there in perpetuity unless it could be utilized on a corporate level tax, which doesn't exist. So what we did was we went in and we were able to get it changed legislatively in this cleanup bill. So now basically the credit can be used by in this case, the upper tier entity, the partnership or the S corporation that's a partner in another entity, can utilize that to reduce its own BAIT, and therefore basically not have to pay the taxes in multiple cases. And in the case of an S corporation, if it is in fact in excess of what the corporation's BAIT tax liability is, they can now get a refund for that. So that was really, really key, because at the end of the day, it made it ineffective for an S corporation who's an owner. It would actually hurt them by creating a tax that gets locked up at that level. So this was another good act. Real quickly, some other changes that were made. If you are a non-resident owner of a partnership in New Jersey, New Jersey's law requires you to have withholding of that non-resident share, taxes on that non-resident share of income. If you're paying the BAIT for that shareholder and paying non-resident, it resulted in duplication of payment. Again, legislatively, we're able to eliminate that. So now only if there's reasonable belief that the BAIT payment itself would not cover that non-resident's share of income, then only and only then would you be required to pay the withholding tax, which shouldn't exist because the way the rates work, it's always at the high, it's going to be at a higher rate than it would be otherwise. So it shouldn't be a problem, I should say. I mean, there's always going to be exceptions to everything. Last but not least, we codified the notion that you can apply an overpayment to next year's taxes. New Jersey's agreed to do that for 2021 anyways, even though in 2020 they said you couldn't do that. It had to do with systems. But this way, there's no question, not left up to interpretation. You know, that the Assembly and the Senate have both made it clear that you should be able to get a refund if you have, apply a refund if you have them. Those are the major areas that were changed. Some of them which will put into effect anyways in 21. Some of them will be prospectively, most notably, prospectively would be the tiered structure situation and the non-resident withholding situation.
Great. No, there are a lot of good changes and things that I know affected me, and I'm mainly audit, and it still affected me. I can't imagine people in our tax department trying to address these situations. I did see them pulling their hair out, and just the overpayment alone, just, you know, in our tax system, you could elect for overpayment and it would not go to the line no matter what you did, if there wasn't even a line. So it made it difficult because people were getting a refund and then turning around having to pay again. So, yeah, and if they have to pay electronically, they do, but they're getting a check in the refund. It just became really difficult. So good job. Thank you very much. You and I know the New Jersey side is working with you on that, I believe, and council, and thank you very much for doing that. Now, you mentioned out-of-state people, and this was a big question, especially because we have New York people. I'm not asking about New York PTE. That's a different session. But we have New York residents, Pennsylvania residents, very close, you know, we could have others, of course. Should entities that have out-of-state residents consider electing this?
So, like every good tax question, the answer is depends.
Thank you. Next question.
Yeah. So let me just touch on a couple of things real quickly. The big issue here is whether the state that is the resident lives in, so the resident owner of a New Jersey entity, the state that they live in, is whether or not they will give you a credit for taxes paid at the base level against your own individual income taxes. So right now, if you're a New York resident, prior to this year, I should say, if you were a New York resident and you had a subchapter S corporation in New Jersey, you picked up 100% of the income in New York and you were entitled to a credit for the individual taxes you paid in New Jersey. That's clear. When we instituted the BAIT, New York said you can't get a credit for the BAIT tax you paid. And since there is no more an individual tax, you would want to pay 100% tax in New York on your income for the same taxes you paid in New Jersey. So in those instances, the answer was no, you shouldn't be electing BAIT unless it's a small shareholder, you know, but if all things being equal, you would not elect BAIT because you have a non-resident shareholder and you want up getting that person double taxed. And you'd have to weigh the economic benefits. But here's the good news. New York passed a PTE tax, pass-through entity tax, similar to the BAIT in 2021. It's effective in 2021, and it says that you will get a credit for taxes that are similar to our tax, and New Jersey is a similar tax to the New York tax. So now, if you have New York residents and New Jersey residents and Connecticut residents, you're perfectly fine in electing BAIT in New Jersey and not getting yourself whipsawed with double taxation. It's a much more complicated with Pennsylvania because Pennsylvania says in one instance, if you're an S corporation, you can get the credit, and the other instance, if you're a partnership, you can't. We got to work on Pennsylvania to get that cleaned up. So I think you just need to, you know, consult with your advisor here at SobelCo. If you work with another firm, talk to your advisor there to make sure you're making the right decision. You don't want to get whipsawed with double taxation.
Right. So the important thing is, and this leads into my next question, before you make any election and start paying taxes, talk with somebody and make sure. If you're a New Jersey company, New Jersey resident, you may not have a lot of decisions to make, except for other personal reasons. Either way, you should be talking with your tax advisor. Reach out to somebody at Sobel Company. Speaking about elections and paying, so all right, you know, we're part of, forget about IDA. I'm going to make a payment now for BAIT for 21. Is that cool? Is that what they do? How do people elect? How do they pay?
Okay, so for New Jersey business alternative income tax, and each state is different. So again, you got to be really careful here. But for New Jersey purposes, the election has to be made by March 15th, following the end of your tax year. So if you're at the calendar year end, you have to file your election by March 15th, which is essentially 2.5 months. So if you're a fiscal year taxpayer, it's 2.5 months following the end of the year. Now, as a practical matter, you may have to make the election prior to the end of the calendar year. I'm using a calendar year as an example, in order to make the payment before the end of the year to make sure that you secure the deduction. Because taxes in general are deductible when you pay them, not when you accrue them. Certainly if you're a cash basis taxpayer, and in many cases, the interpretation is if you're an accrual based taxpayer, it's when you pay it. So again, if you're a calendar year and you make the election in March and pay the tax in March, then you may not get the deduction for the calendar year, in this case, 2021, until 2022. So to maximize it, you may make the election before the end of the year, make your payment, and then if you decide that you don't want to have the regime apply to you, you want to elect out of abate, New Jersey allows you to revoke your election. So you just have to do it by March 15th. So you have a great deal of flexibility for planning here that you might not have in other states, or had it been much more rigid, like Connecticut, for example.
So even if you paid in, you can elect to revoke and get your money back
and get a refund. Yeah.
And
anecdotally, Brad, I will tell you this: at our firm, we filed our tax return in or around, I'd say, early part of December. We got our refund on our bait because we overpaid our bait. We got a refund of that before the end of January. So New Jersey's not really slow in returning those refunds, unless, of course, there are complications that are beyond their control.
Interesting. There were available extensions past October 15th. That's why we filed in December. Okay.
Yes, exactly.
I don't want them questioning. I can see all the comments that come in. So I want you to put on the hat, and I want you to have the envelopes in your head and be Karnak here, and tell me, what changes do you expect in the future?
So I think at the state level, I think we're pretty much done. If I had one wish, it would be that we can get this to apply to sole proprietors, Schedule C people, individuals who don't file an income tax return for federal or state purposes. Because again, my notion here has always been that as a business, the profits that you generate and the taxes that you pay on that profit in state purposes is an ordinary and necessary business expense. And so that would be a great thing to do if I could do that. I don't know that we have the political power with which to do that next year. I think people are tired of debating at this stage of the game, so I think we're done. But if we could do that, that would be a great thing to be able to do. I might add, there are ways to plan around that. So if it's significant enough and you're a sole proprietor, you can plan around that. I don't want to take the time here to talk about it, but talk again to your tax advisor here at SobelCo or anywhere else, and they can hopefully advise you on the ways to do that. I think the changes we may see as it relates to this is going to come from the federal level. We're waiting still for regulations from Treasury on this whole pass-through entity regime. The good news is in November of 2020, the IRS, Treasury came out and said they are supportive and believe that the PTE taxes, the state tax, pass-through entity taxes are legit, that it's perfectly acceptable to have a flow-through entity pay the tax and have it treated as a federal deduction. They made it really, really clear, but they said they're going to come out with regulations. And so one of the big questions here is, so what happens if I pay taxes at the entity level and it results in a refund to me at the individual level because I'm paying at a higher rate or my taxable income is lower than actually I report at the entity level? It's unclear right now as to how the IRS is going to do that. I have my own views on that, and real simply, it's that you'll pay tax on that extra income because you shouldn't get a benefit. It's called the tax benefit rule. You shouldn't get a benefit flow through you and then you see money back that's not taxable. But it's unclear, and there are many practitioners who've said the opposite of what I'm saying. So I suspect they're going to address how you calculate your taxable income as it relates to overpayments. I should say refunds on a bait tax or a flow.
Okay, so somebody trying to game the system and pay an extra bait and stuff like that. Oh, okay. Oh, great.
Exactly.
I was thinking all the good things about it. Why'd you have to tell me to have somebody trying to game the system?
Because I think we need to prepare for that. That's a even if they're not gaming the system, I think it's a real issue that's going to present itself.
Sure. Well, it's great, Alan. I know that people were concerned about this last year. We're concerned about it coming out again this year. I mean, I'm already working with returns and clients are starting to ask about it. So It's great you provided this information. Again, thanks for pulling this together with you and the whole team that was involved with this. And we look forward to having you coming on another topic, maybe accounting. I don't know. People don't seem to be asking for that.
We'll find up an interesting subject in accounting to talk about too.
Sounds
Brad,
great.
thanks. I appreciate it. As you know, this is really near and dear to my heart, and so I love to talk about it. And I'm so grateful to the assembly and to the senators and the leaders in that area, to Governor Murphy, even who signed the bill, but most importantly to the New Jersey Society of CPAs, who provided tremendous leadership in this initiative. And so it's a great thing. We're saving a lot of money to business owners, and I think it's a real positive.
Great.
So, thank you.
Thank you again. And thank you everybody for watching. Again, let us know if you have any ideas for topics or speakers. Have a good one.